Hello everybody, hope you're doing well. Hope you had an excellent weekend. Welcome to another episode of Monday Markets brought to you by FTX. Links available in the description below. If you want to check it out, there's some new additions to the description box. Finally, we've been able to publish our crypto leverage trading for beginners guide that we've worked on for a while. Well, actually, it didn't take that long, but we've been sitting on it for a while, I suppose. And for those of you who want to explore FTX's other products, not just the mobile trading app, some of them do offer leverage, so we thought it would be wise to kind of have a quick guide, explain a tutorial type of thing, so that you know what you're doing if you do choose to go down that route. We also have our ref links there, so if you want to support the channel and signing up via the link and getting some fee discounts, that's fine. If you don't want to, that's fine as well. But yeah, just this kind of free informational document. I think if you watch that alongside the risk management video that's shilled somewhere here as well, here we go, from my main channel. And then there's also another Google Doc which has open interest, funding, and all that type of stuff regarding the futures specifically. I think if you do those three things, you'll be in a pretty good spot to at least know what you're doing. If you want to ignore all that and just sit here for the YouTube videos, that's totally fine as well. We love to have you. But given some updates coming out on the platform and just the crossover between the mobile app and the other products, thought we might as well make some content around it. So go check it out, maybe even a refresher course for those of you more experienced. And if you want to support the channel, link is available in the description below. So let's get to business. First things first, in terms of news or things to look forward to, or not really look forward to, but things that will hit us whether we like it or not. We have, I think the main thing for this week is the US CPI data, so inflation data coming out on Thursday the 13th of October, as you can see here on Forex Factory, which is the site I use for all my economic calendar type of things. Market's been quite sensitive to these CPI prints, and we're coming up to earnings season fairly soonish as well, and all sorts of macro stuff still matters. As annoying as it is, we're still very much correlated, and these headlines do have an impact. So in terms of at least short-term trading, but also for the medium-term trend, these inflation prints do make a difference, as we've seen. So that's one to have on your radar for Thursday the 13th of October. The other point, kind of contextually, and this is from Kruger Macro on Twitter, this is a kind of measure of Bitcoin's volatility. It's reaching sort of historically low levels, which have in the past led to quite sharp moves. 50% down in 2018, 240% up in 2019, and then 35% up in 2020. This isn't a directional indicator per se, it's just more a volatility indicator. And again, as Zahir noted here, that maybe there's some sort of ETH angle to be had to whatever it may be. As you've noticed by looking at the price chart, Bollinger Bands, no Bollinger Bands, price action, volatility index, we're really sort of compressing the volatility for the last couple of months or so. Certainly the last month has been a bit rough, pretty much trading between 18 and 20 flat. And then to be honest, you could take the liberty of outlining this whole thing as a range. And in that case, we've been here for quite a while. If you start with this consolidation started on the 15th of June, today is the 10th of October. So all the way from June to October, 117 daily bars here of more or less chop. So that comes to an end soon, I think, or sooner rather than later. Big periods of consolidation typically precede big areas of expansion, and with a ton of macro and real world catalysts coming up, with again inflation data, FOMC soonish after that, earnings season, I don't think we're going to be range bound until the end of the year, or at least I want to see some signs of volatility. So as far as price action goes, I really don't want to make it more complicated than it has to be, and I think the market's been very clear in terms of the levels that matter. If we take this prior all-time high at 20k and look at the price action around it, that's sort of just been the story of the market. On the monthly time frame, we had that as support. We closed below it, not a breakdown type of close, but still a close below nonetheless. And at the moment, it's been acting as resistance. That's very visible on weekly and daily and pretty much any lower time frame at that point, especially on the daily, where all these rallies have essentially been capped off and stuck under 21k, so in the 20,000s, the low to mid 20,000s, the market's just been pushed down repeatedly, and overall, just structurally, it seems like, especially if you look at it on the weekly, this 20k area, 19.8, 19.9, 20k, 20k round number, whatever you want to call it, at the moment, it's currently acting more as resistance than as support. And that's not great, right? That's not what you want to see at cyclical levels or at strong levels that matter a lot contextually for the market. And this is certainly one of them. So at face value, I know that's become one of my catchphrases, but I do think it's important for this type of trend. Like, the first thing you want to see is for 20k to stop acting as resistance and turn to support if you want to be constructive on this market. market. Now, it's not asking for a lot, right? It's the price cycle all-time high. It's a very important level, and it's not a particularly unreasonable or high bar to set to say this is quite a clear line in the sand as far as the market goes. I want to see that the market trade and be accepted above it as opposed to trade and be accepted below it. And I really think if you kind of just keep that structure in mind, it'll keep you on the right side of things, or at least give you clear trading expectations. In terms of other follow-ups, I know we've kind of delineated this weekly range in several different ways, and it doesn't matter because it all comes back to 20k in any case. But one of the ways we outlined it was using one of, if not both of these lowest closes on the weekly that have taken place during this consolidation. And from the available evidence, these are still acting as resistance, and no surprise, they're all around 19 to 20k, right? So in terms of what would make this constructive, I think at the very least, and it's not asking for a lot, as I've said, you want to see 20k turn from resistance to support, and then maybe we have some sort of signs of strength. I know that sounds desperate, but that's just state of the market right now. Or if you want to be a bit more sort of structure based on the weekly time frame, this cluster that we've spoken about on Technical Roundup, the newsletter and the YouTube channel, that rests at 21k or thereabouts, you want to see a weekly close above that to suggest that the mid-range is at least has been reclaimed, and that's also above 20k, and things start to kind of look constructive. So we're still waiting for some signs of strength, be that at 20, be that at 21. It's a bit of a distinction without a difference. You want to see important levels turn to support and acceptance above them. At the moment, that's not quite been the case, and it's kind of the range is compressing into ping pong between sort of 18 and 19.9, and that's not going to generate much signal, especially for those of us who care about higher time frames as we do on this channel, given it's a weekly show, right? So same old structures. Again, I think if you want to take the easy way out, and that's not even I'm not using that pejoratively, I simply mean, they'll kind of give you the whole picture. You can just have this prior cycle's all-time high at 19.9 mapped out, and as long as you don't get daily or weekly closes, or, monthly or weekly closes above it, it's worth being cautious, skeptical, conservative, whatever it may be, right? And in terms of where the market is right now, it's sort of drifting lower towards the bottom of the daily range that we've spoken about for some time, which is, sort of this 18.9, 19k type of structure. And that's been tested again, depending on how many times you count, 1, 2, 3, 4, 5, and, if it pushes down lower, this will be the 6th test of support. And I'm just not a fan of rebuying that. I certainly don't have trade setups that allow me to punt at levels that have been tested more times than I can count, unless there's something really, really compelling that takes place at that structure. But overall, kind of rule of thumb, this many tests of a range, especially with compressing volatility, if I'm caught on the wrong side of buying that type of level, it's not like I'm going to buy 18.9 and get invalidated at 18.2. I'll probably get invalidated at like 16.9 when I finally get my fill, right? So a lot of the time, the cost of being wrong goes up the more you bet on a level and the more it gets beaten up, right? And I think if the market wanted to show signs of demand, going above 20k shouldn't be a tall order, or even going above the 21k weekly cluster isn't a tall order, and it's done neither of those. So I'm still sort of patiently waiting. You'll recall the daily range we referred to was this kind of 22 to 18.9 type of range, and so if you get a close above the midpoint of that range and acceptance there, then you could start to build a picture that, look, we have 20k turning from resistance to support, and it's also a reclaim of the weekly mid-range, and then maybe you could make a case towards the range high, if not higher. But again, those are counterfactuals. At that present, that type of evidence doesn't exist in the market. So if you want a kind of line in the sand type of thing, 20 to 20.7-ish to encapsulate the prior cycle's high wick and the daily mid-range. Waiting for that to be reclaimed would be the first in some time, a non-trivial sign of strength, and maybe that becomes interesting. But, as I'm talking to you, it's like the 6th test of the bottom of the range, and also it's below 20k, and 20k has been resistance, not support. So, my enthusiasm is certainly going to be grounded in the face of those facts. And again, just bigger picture kind of volatility-wise, or in terms of the high time frame range resolution. As I've argued before, the longer we stay here, the less kind of optimistic I become, because it starts to become a reasonable analog of 2016, I'm making stuff up, 2018, where the market just hit a level, it just went absolutely nowhere, consolidated, volatility compressed until eventually it broke to the downside. And that the good news is that breakdown ended up being the final breakdown on the bottom. The bad news is it was like a 50% decline from 6k to 3k or whatever it was, right? 3.4k, mid 3000s. So back of the napkin math, 50% decline. And the longer the market spends at 20k without showing signs of demand, and the longer volatility compresses at that level without any type of support or positive market structure or constructive market structure, the more reasonable that analog becomes. That 20k is the new 6k, and look out below, wait for the breakdown, whatever it may be. So that's one thing I want to see, get us away from 20k, because staying there doesn't lead to many good conclusions. As far as kind of high volatility scenarios, like what would volatility look like if it came back into the market, and that BVOL index that I mentioned from the tweet came to fruition, what have you. I really think one thing you don't want to do is fade that too early, right? Because this, in one way or another, at least on the weekly time frame, depending on how you measure, it's like a 16-week range. We've got quite a few months going here from, depending on when you count, the conception of the range from June, and we're in October now, having not really done anything, right? And you might look at, but look, we went from sort of 20k to 25k. Well, that's nothing, right? It didn't even have the decency to retest the broken support and resistance at 30k, and also we had like a face-melting counter-trend rally in equities, and Bitcoin took no part in that. So this is still very much a kind of range-bound environment. So the risk that comes with volatility expansion is that if you fade it too early, there's a really good chance you get carried out, right? So if you're used to, for example, trading or fading 2, 3, 4% moves for mean reversion, and your P&L goes print, the second the volatility picks up and you're used to fading, 2, 3, 4% moves, and then you get a 10 to 20% move, if you're on the wrong side of that, and especially if your sizing's been going up or you're not adjusting it for, how volatility is being priced, then the likelihood that you get carried out, as in your account blows up if you're on the wrong side of that, is pretty damn high. And you'll certainly be at risk of giving back a lot of your gains. So one thing that's at least on my mental checklist of what not to do is to fade this too early if it really starts to expand, be it to the downside or to the upside. I mean, the current technicals, and I hope they do change in the next week or two, suggest down, given we're below support kind of at face value. But in any case, whatever volatility expansion you get, I think if you apply the strategy that's been working for the past couple of months of fading those small moves, if you're on the wrong side of that, God help you, right? And I don't want to be that guy. So basically, if the market breaks down, I'm going to let it break down. I'm not going to step in and try to catch some wicks at, 18 something or whatever. I'm going to let it go and see what it does, how long it goes. Because, if it starts breaking down, you have to realize it's an impulse down. It's like a multi-month consolidation and then an impulse down. And usually, the greater the consolidation, right, the longer the consolidation, the greater the expansion that follows. So I don't want to risk stepping in front of that too early. So I'm just going to let the market do what it does. If it breaks down and wants to reach kind of other, for example, older cyclical levels, be that at monthly support 14k, 12k, what have you, I'm going to let it do that. If it wants to break down and then eventually form a failed breakdown type of structure, right? So if we take this weekly extreme as one of our levels, if it wants to, for example, break down and then fail and eventually sort of come back into the range, that's certainly tradable for me as well. What I don't want to do is do a lot of business on this portion of the leg where it's breaking down, it's in the middle of nowhere, it hasn't really moved that much, but I'm just stepping in assuming it's the old market regime when perhaps we've seen a shift in the volatility regime. Fading consolidations that break, especially if they're long consolidations and they break, if you fade that too early, you're done, and I don't want to be that guy. So if you want to break and take me to cyclical levels, I'm there to do business. If you want to break and then the break fails and then end up in some sort of reclaim, I'm there to do business. Anything else, especially stepping in too early, and I can't stress this enough, is not something that I'm terribly interested in. And obviously the same applies for the upside scenario. If the volatility expansion is to the upside, the same rules apply. I'm going to let it go until it either reaches much more attractive levels of resistance, or it proves that the break has failed and it's a deviation or what have you. So I guess one text version of summarizing it. So volatility compressed. If you fade vol expansion too early, you die, right? Which I truly believe, and price action does reflect that, and history reflects that. So reasonable options. Option 1, if it breaks, let it go, get to better levels. If it breaks and ends up not following through, trade it when it's back inside the range. I really think this text kind of summarizes my views and I think a decent sort of conservative approach to volatility expansion. The elephant in the room is because I'm not a breakout trader, I'm not advocating for breakout trading. You could make a case for it that, oh, look, we're at historically low volatility. If there's an impulse, maybe that's worth chasing. And if that's your argument, I'm sympathetic to it. But given this is a show sort of by me and it reflects my own views and my own sort of likely trades to take or the types of setups that I like, I'm not going to have kind of a momentum continuation type of thing because I know the likelihood of me trading it is incredibly low. So what do I do in those cases? I mean, you can just sit out and do nothing, which has been quite good this year. But I think if you're anticipating a shift in the volatility regime, especially at kind of this important 20k level, if it breaks, you let it go and get to better levels, whether that's better support lower or better resistance higher. You just wait for it to travel out of this range and get to a new range or get to fresh levels that you get to trade for the first time, first test, best test, all that good stuff. Or if it breaks and it doesn't follow through, you just wait until it gets back into the range and then you trade it as a standard bread and butter deviation failed break type of setup. Okay, I'm going to delete this text in a sec. So if you want to pause it or look at it, whatever, do that now. And also, we do appreciate all of your comments and likes on the video. It does make a big difference. So if you want to do that now, as I'm chatting along, leave a like on the video and that helps us. Anyway, I think that's BTC USD, fairly self-explanatory. If not, leave a comment and I'll try to respond to you. As far as ETH goes, nothing too sort of different there. The monthly time frame is less obvious, but it suffers from the same fate of this prior cycles level acting more as resistance, or that area is more resistance than it is support, and that's sort of been self-evident on, I mean, especially on the weekly time frame, right? Like the sort of story here is you can take previous cycles levels and use them as line in the sand. 20k has been a line in the sand for Bitcoin, and at the moment, from the available evidence, 1400 has been a line in the sand for ETH, albeit it's been tested far less, right? So if you look at this, like perfect weekly retest, this ended up being a deviation, perfect weekly retest, and now that's turned to resistance, right? It's even clearer on the daily time frame, where the kind of best, most obvious multi-touch level, support, breakdown, is at the prior cycle's all-time high at 1400. So again, similar to Bitcoin, we could just apply a very simple heuristic to this and say, look, if you want me to be even remotely excited about this market, you should be able to trade above and be accepted above and reclaim whatever previous cycle's high at 1400, hopefully, or necessarily above this daily cluster here, and then we can trade towards this larger consolidation in general and sort of break it down, and we'll cross that bridge when we get there. My eye is drawn towards this kind of 1500 cluster, the pre-breakdown point, but in general the first sign of bullishness would be turning previous cycle's high, which is resistance, into support, and that's currently not available to us. In terms of where the market's playing ping pong right now, I mean, this range is really tight, very hard to get excited over that. I think the two levels that will give clearer signals for bias is above 1400. You can start to make an argument that this looks less shit than before, and below 1200, which is this sort of ETH merged rally breakout type of structure, you can make the argument that the market is more shit than before, and we're sort of between levels right now, as you can see, and it doesn't even give you the courtesy of testing those levels either. It's just been sort of in no man's land to a large extent, right? So above 1400, hey, it's not as bad as we thought. Below 1200, hey, it's worse than we thought. This to me is completely uninteresting and almost untradeable, at least when it comes to higher time frame weekly videos, swing trading ideas, what have you. And I'm not going to read into the daily or intraday time frames too much. If you want to treat it as a range, which has been the story of the market for the past months, I think that's completely reasonable. You've got a fairly obvious range high just under that 1400 level at 1370s, 1380s, and a slightly less obvious range low, depending on how you depict it, at 1300 or thereabouts. If you want to trade that, totally fine, be my guest, whatever. I just do want to express some caution at continually applying very sort of narrow, small percentage, mean reversion range trading strategies when we're at historically low volatility levels. If you get caught on the wrong side of that, like the shift in volatility with the same strategy, you're gonna have a rough time. So I would certainly at least size down or be aware that hopefully, but also just the evidence suggests that we won't stay sideways for too much longer. As far as indices go, they've been still very, very technical. You'll recall that Don and I, both in the newsletter on Casual Friday and just on these streams, we were talking about how technical this market is and all the support to resistance flips. That's what's kind of indicated by the current price action. This monthly cluster at 3710 to 3760 gave you a first bounce into resistance, broke down, and now it's currently acting as resistance once again. Not much else to say there. You want to see that at least getting validated on the weekly time frame before getting too excited. It is a monthly level, so if you want to be really conservative, you wait for the monthly close. If you want to kind of front run it and act quickly, even though you have less quote-unquote confirmation, you want at least a weekly close above 3760, maybe even above 38.20s if you want to be really safe. But in any case, you want to see this area, which is quite clear, monthly and weekly structure, turn from resistance to support. Maybe that happens this week, but again, at the moment, that argument isn't available because you had a rally into it, it closed below, and both on the monthly and the weekly, in its current form, that sort of 37.10, 37.60 area is resistance, not support. So until that gets reclaimed, hard to be too excited. It looks like a breakdown and retest, and I need the market to prove to me that it's something other than that, right? Similar considerations, of course, apply to the Nasdaq. We had this very clear monthly cluster between, I think that's 11K and 12.1. Or 11.1 and 12.1. The markets began then very technical. You had a weekly close below the cluster. Sorry, monthly close below the cluster in the last month. This month opened, rallied exactly to the midpoint, and also this kind of previous candle underside level, and is currently below it as well. So similar story, unsurprisingly, in the Nasdaq. You had a breakdown of high time frame support, a retest, and it's currently below that level once again. So nothing really supportive in indices to say that, hey, maybe we look for crypto strength because we have a kind of reclaim or a bullish setup in indices. We don't. Indices at the moment look like they're coming off a backside retest of broken support and resistance, both in Nasdaq and in the S&P. I know that all sounds very doomy and gloomy, but I'm just kind of looking at the market for what it is, and I don't feel like I'm being unreasonable by saying get above 20K and then we can have a conversation. That to me seems like a very low bar to set. The one bit of copium, hopium, whatever thing I might be able to leave you with is that if we keep getting weekly candles like the last 2 weeks and we don't break down, that might be okay. So for example, you look here based on the last 2 weeklies, and if you have this level again, 19 whatever, 19.5, 20K, etc., you can see green close, long wick, looks like a bearish retest. Another one, green close, big wick, below the level, looks like a bearish retest, etc. If we keep printing that, and I messaged Don about this on WhatsApp this morning, if the market kind of keeps kissing the underside of 20K with these long wicks while slowly kind of marching up without breaking down, and that's really the important formula, without breaking down, then that could be a bit of a kind of bottom type of price action. And the analog that I have in mind is actually post-COVID recovery. Where is it? I remember it like it was yesterday, or apparently, oh yeah, here we are. You had a very similar type of price structure in the kind of 5 to 7,000 range, where the market, had a big liquidation move. It was just grinding up, and I remember thinking this looks like the most bearish retest in the world at around 7K, and you can kind of see how the weekly candles transpired, right? You have green close, retest, closes below. Again, green close, retest, close below, but gradually the market just marched up until that level was reclaimed, and then it just kind of shot up to the top of the range, broke out, and then that's your crazy bull run, right? So if you're looking for some sort of bullish hopium or some maybe weekly time frame trend to look out for, it would be something like this, which is kind of bearish retests of 20 to 21K on the weekly, which don't go anywhere. So the bearish retest didn't send the market lower, it just kind of ended up grinding up until eventually the level got flipped and the market moved higher. So, if we get 2, 3, 4 more weekly candles like this, where they have these long wicks, they end up being green, and the breakdown, which looks like it's going to happen any week now, never ends up happening. And especially, and as you saw in the previous chart, the trigger ended up being finally the close above or the flip or whatever it may be. I think that would be a useful signal. Just a bit of hopium there, that setup isn't readily available. But if you get bearish retests which don't follow through, those do eventually turn bullish. That's something to maybe we can kind of passively keep tabs on in the next few weeks. That's all from me. I hope that was helpful. Let me know in the comments. Again, we do read all of them and appreciate all your likes and subscriptions. Thank you again to FTX for supporting the show. Check them out. Links also available in the description below. If you want to check out FTX US, if you're from the US, or the international platform, if you're from a non-restricted jurisdiction, you can sign up with our link. That gives you discounted fees and gives us like $10 before you get liquidated. But it is a nice way to support the channel, and we do appreciate you if you choose to do that. Even if you don't want to, there is a free leverage trading kind of refresher, reminder, guide course for you and all your beginner friends. That's in the description, so be sure to check it out. That's all from me. Have an excellent week, and remember, the newsletter comes out tomorrow, trletter.com. Wednesday stream and all the usual content coming your way. Grateful for your attention, your time. Thank you again, and I will see you next week. Goodbye.